Hello, welcome everyone to the Manulife Investment Management Asian Equities Outlook webinar. I'm Grace, your moderator today. Now, before I introduce the speaker, I want to just mention that you can type in your questions in the space below the screen, and we'll be taking questions right after the panel discussion. Now, I'd like to introduce the speakers. Sitting next to me is Mr. Ronald Chan. Ronald is our CIO for Asian Equities. And sitting next to Ronald is Kai Pong Chai, our Senior Portfolio Manager of Greater China Equities. I call him KK. So let's start. So first question for Ronald. So after the COVID-19 market correction, to what extent did Asia show signs of recovery?
Okay. I guess the market has seen quite a lot of volatility, especially in Q1 was really impacted by COVID-19. And that was followed by the shock in oil prices. In Q2, you're starting to see the rebound, benefited from central bank's policy, and a number of government has been very bullish in terms of giving out fiscal stimulus. And then as the economic situation beginning to unwind, you're seeing some recovery in equity prices. If you look at the chart that I've got available here, and that really shows you the impact of COVID-19 globally. As you can see, this gives you a kind of flavor before and after the pandemic. And you'll see that on China and Asia, back in January, the market was looking at a 5.8%, 5.4% type of GDP growth. And after COVID, back in May, that has been revised down to 3%, 2.9% respectively. If you look across to US and to Europe, that number went from 2.3 to minus 6.5% for US, and for Europe went from 1.3 to minus 10%. This is quite a dramatic drop in terms of GDP forecast, just on the back of the COVID-19. Now, forward that to 2021, you see that most of the market will be expected to recover, more so for developed market. But having said that, you can still see that for China and for Asia Japan, they are expected to grow as high as 7.7 to 7.4%, and that's higher than the developed market. So despite the fact that Asia have got a higher base from 2020, they can still enjoy a higher than world growth into 2021. So our base case, based on this, is that we've seen the peak of COVID-19. We will, unless we've seen a improvement in the availability of the vaccine, the economy will continue to be subpar in terms of the growth rate. Therefore, the policy support will continue to be there for the next 2 years, as has been suggested overnight by the Fed. So based on that, we would expect that the earnings growth for this year will be pedestrian. For next year, we expect it to grow as high as 20%. So given the current valuation, our estimate is that the market is likely to be a range bound, and then even with an improvement of 10% upside for 2021. And that is based on how we see the market compared to his own history. Now, relative to government bonds, Fed is basically giving out very, very little. If you hold bonds to maturity, if you hold some of the European bonds, will be negative return. Compare that to property. Either that you are facing with oversupply situation, or you're facing with government measure that want to climb down property prices. So relative to the other two asset classes, we still think that equity will give you that potential risk on the upside. And that potential risk on the upside could come from the availability of the vaccine. So that is from the top-down perspective. From a micro perspective, I think the impact of the pandemic has really driven in two areas, give rise to two areas. One is that it turns the economy to be more digital. The other one is turns the global economy to be less global. Now, what I meant by digital, we've seen on the back of the pandemic, government has been very keen in doing investment in digital. The 5G rollout in terms of digital infrastructure. At the corporate level, because of work from home, you've seen a number of companies, in fact, quite a lot of companies want to buy more laptop so that people can work from home. At the parents level, you and me probably, experienced during the COVID-19 times where people, we need to have our kids to study at home. So we probably want to, increase our broadband, speed. So in terms of digital investment, you've seen a bit of that going on. In terms of digital health, we also, in the case of China, we've seen people that actually want to do their normal checking, the health check, using the mobile phones, using online, as opposed to sitting at the waiting room waiting for the doctor, running a risk of catching COVID-19. And then you also seen the way that we do marketing has changed. Now we're using more KOL, we're using more social e-commerce as opposed to the traditional e-commerce. Even the central banks now are talking about digital currency. So digital is coming in very different, many different forms, and I guess that that will give rise to a number of bottom-up stock picking opportunities, and most pertinent in the North Asian region.
Thank you, thank you. So yes, so basically 2020 continues to be difficult, but 2021, it looks more positive from your point of view.
Right.
And you've elaborated on the digital element, and I'd like to hear from Ronald as well, on KK as well, on the digital factor and the implications in the Greater China equity space.
Yes, as we all know that China is pretty advanced in so-called digitalizing its economy. E-commerce is already 25% of total retail sales, and that is actually accelerating very fast. And if you look at the next chart, you can see that already more than 50% of online payment users are actually from tier 3 and lower cities. And actually, the growth rate, the new active user on online payment is actually coming more from the lower tier cities. That have actually implied a lot of things. It means that the so-called e-commerce is expanding to the lower tier city. Why is it so? It's actually driven by an interesting new e-commerce company that actually try to address the lower tier city, the demand. They focus on value for money kind of deals, and also trying to get people to group together to buy. So that's why increase the penetration on these lower tier cities, and actually post COVID, during COVID, the lockdown, these features are even more stronger in a way that even the older generation, those older than 50 years old, are actually using these online apps to do buying their grocery and taking food delivery. So that actually helped to grow users a lot, and also let them experience the efficiency-ness of the cost and the time saving of these services, and as a result, they build more users at the same time. The second thing we notice is also because of this COVID lockdown, online education actually took off by a lot. Previously, the penetration is less than 5% of total, but now we're looking at maybe 15-20% this penetration. But this is supposed to happen 3 years later. But because of this COVID lockdown, the parents experience this online so-called tutoring, and they're actually accepting this business model. And as a result, a lot of companies that offer very good online courses or online services are actually benefiting from this trend. And last but not least, there's also changes in how companies think about their manufacturing. Because of this COVID lockdown, companies are actually looking to more automation, to be less reliant on labor, and as a result, they actually invest more on automation, and we see that trend potentially accelerating with the introduction of 5G, and companies are start to build smart factories, rely on more machines and automation to do their production.
Right. Okay. So the e-commerce adoption goes up in tier 2 and tier 3 cities. So the universe or the pie is getting bigger for the e-commerce area. And then for the more automation, more machinery. So from that development, what kind of so in the tech sector, do you have a particular preference between in the tech sector?
I guess there are different winners in this mega trend. Of course, technology is one of them, and there's also people that provide equipment for those automation companies, as well as in terms of e-commerce. Definitely, other than the big e-commerce players, there are also emerging new e-commerce players that address better to these lower tier cities. I think that will be we are quite sure that they will see very strong growth and good investment, so-called candidates for us.
Yeah. Okay. Now, that's the more positive side, investment opportunities, but also we're seeing a rising tension, geopolitical tension between China and the US. So what's your view on that and the impact for the greater China equities?
Yes, this tension has been happening since, I think, 18 months ago, when Trump became a bit more focused on trying to bring jobs back to the US. So I think and because of the US election year this year, so this tension is here to stay. But I think we have seen the worst of it, and at the same time, that also forces China to look at themselves, trying to look a bit more inwards to boost their domestic consumption. So definitely, this being less global affects a lot of Asian companies, including the Chinese one. But there will be winners and losers in this trend. Winners will be those that can address to domestic consumption, services, consumption upgrade, and also because of this this tech war between US and China, China will be wanting to build their own semiconductor supply chain to be less reliant on US, and that will actually benefit the Taiwanese and even Korean semiconductor companies, the IC design, and we see quite interesting mid-sized company that are seeing very good growth from this trend. And because we have a good analyst coverage with the help of our JV in China, Manulife data, we are able to discover these names earlier than others.
Right. So so that's the less global opportunities that you're seeing. So Ronald, from your view, this less global, how does it impact the capital markets?
On capital markets, I guess Kiki was talking about being less relying on others, being more self-reliant. And I guess over the last few years, what you see is that the Chinese have been in the process of getting more of a renminbi internationalization. You've seen the quota being removed, the QFII quota. At the same time, you've seen China A being adopted into MSCI index, and therefore through the Share Connect scheme, you've seen incremental more foreign investor going into the China A market. Now, the last few weeks, you saw a lot of news about the trade friction being extended into the tech war, and then into financial tension. Now, what we learned is that the Commerce Department of the US has been saying to the Chinese company that are listed in NASDAQ, telling them that you need to disclose your order details. Failing to do that, then you may face the risk of being delisted in the course of the next 3 years. What we said on the back of that, we've seen a number of Chinese companies who want to return back to Asia, in particular Hong Kong, to be listed on the Hong Kong Stock Exchange. We had one listed last year. In fact, we have one listed today. We're going to have one listed next week as well. And obviously, Hong Kong Stock Exchange will welcome them with open arms. And the implication of that is that the Hong Kong index will be changed quite dramatically. Now, as you can see on the slide here, which give you a comparison of what the sector structure look like of the S&P 500, compare that to the current Hang Seng index. In the course of the next 3 years, if they say the top 10 companies from NASDAQ, the Chinese company from NASDAQ, coming back to Hong Kong, you will see that the sector composition of the HSI will be very, very different. In particular, for the consumer sector, as well as for the IT sector. Our estimate is that if the top 10 companies come back, the weighting for these two sectors will go up from 10% to 20%, which would be very similar to what is the current sector positioning for the S&P 500, which means that the earnings growth will be dramatically improved for HSI, which currently being dominated by the financial sector. The multiple that people will be willing to give to HSI will also be increased. Currently, the S&P 500 is trading on 20 times. HSI is trading on 10 times. S&P, the recent strength over the last 18 months has been dominated by all the so-called FANG names. So the HSI will have its own equivalent of the FANG names going forward, and that would obviously draw a lot of investors' attention.
Right. So the capital market will also be likely to benefit from this less global situation. Now, right now, I think I'm seeing some questions coming in. So I think we'll start taking questions from the audience now. The first question is for Ronald. So apart from the COVID-19 recurring possibility and also the trade tensions, what other risk or events could trigger short-term volatilities in the Asian markets from your point of view?
I think we've seen the peak of the COVID-19 version 1. Whether there's going to be a version 2 and how dramatic that is, we don't know. But the fact of the matter is that a good story can only be told once. And so the second version of that, it may be of a smaller scale, but even though if on a higher scale, in terms of the sentiment, the impact will be a lot less. That was my first initial thought of in terms of risk. The second risk that I could think of is we've been talking about a different type of tension. How far that tension will be evolved into something that we couldn't think of, i.e. we can't really put a price to that, and therefore we cannot value it. And so that will be something which could be worth investors to think about. The third element of risk would be the general election in the US. Now, whether we will have a new government, we don't know. We know about that in November. But hopefully, we will have a government that is less transactional and less unpredictable. So while there's risk, there is also upside risk. So at the margin, those risks should be of a lesser magnitude than what we know of in the first half.
Right. Okay. So some of the risk you've explained quite clearly. So and then when there's risk and also there's opportunity, I also want to hear from Kai Kong or KK on some of the names that have been hardest hit by the COVID-19. Are there recovery plays that you think would be of interest?
Definitely. I mean, especially in certain sectors that are affected, like the auto parts, because of the plant closures in the US and Europe. The auto parts company actually came out a lot. But at the same time, that when things open up, orders will come back. And also, we are increasingly seeing people after experiencing COVID, they actually want to be less reliant on public transport and want to have their own cars. I know at the same time, there's also the electric vehicle trend happening. The consumers are actually moving to buy more electric vehicles. So those companies auto part companies that do all these electric vehicle components are actually seeing quite visible structural growth from that orders. So I think it's a good level to be looking into them, and because the revenue actually will rebound and actually do better after this lockdown. And at the same time, we think that a lot of domestic travel companies or services are actually good opportunities as well, especially those that are in the duty-free retail retail side, as well as those that offer maybe hotel services that they are also seeing a rebound. I think we are more constructive on the domestic travel side rather than the international travel. We think that recovery will be longer.
Right. So the domestic travel, the automobile sectors, and then there's a question for Ronald. So back to the point about the tension between the US and China. So how does that accelerate China's need and China's looking to the ASEAN market to mitigate some of that tension with the US?
That's a very good question. I think we talk about the digital and how that have benefited North Asia. I guess on the ASEAN side, there is various opportunities that's available, although there people need to be very, very selective. On the back of the COVID-19, we continue to see the situation, or what we call the COVID curve in ASEAN, is still relatively disappointing. There's still a lot of new cases being developed. So that means that the overall mood of investing into ASEAN, you need to be very selective. But having said that, we've seen opportunity from the space of the availability of protective equipment for the healthcare sector, along the lines of the industry that manufacture gloves. That has been very beneficial to them. There's been talks about more supply chain relocation away from China to the rest of ASEAN. So for companies that are exposed to US OEM or European OEM that have got a decent labor supply force, be it in Malaysia, be it in Vietnam, has been able to benefit. Companies that manufacture or produce consumer staple products has been able to benefit because of the surge demand from China. China obviously want to hedge the bet in terms of food supply away from Brazil, where they are seeing a very dramatic increase in COVID-19 cases. So in pieces, you've seen opportunities, but people need to be cautious of the fact that the healthcare system within ASEAN has yet to catch up, and therefore the general consumption story has yet to pick up meaningfully.
Right. Thank you. So there will be companies who will benefit from China's relocation of the supply chain, but then there are also the COVID-19 situation in the ASEAN countries has yet to be contained. So I think that's a message for the investors. Now, there's a question for KK. So you talked a lot on digital. There's a question from the audience who wants to hear your view about the energy sector in China.
Good question. Tell me what's your view on oil price first. So I mean, the energy sector, is of course driven by oil price. But to us, I think we identify a structural growth area in the energy sector in China, which is the gas distribution. You know that gas, so-called consumption as a percentage of energy has been creeping up. It was less than 3% before. Now it's close to 10%, and actually China want to push it to maybe 15 to 20%. So that is a very so-called long-term structural growth story. And as the Chinese become more environmental concerned and adoption of gas, and gas prices actually coming off with the opening up of the Chinese pipeline in the future, we believe that you can see stronger than GDP growth in terms of gas consumption. That's why we are actually more positive on gas distribution companies.
Right. Thank you. Thank you. Any more questions coming in? Because I can't. Can you move the questions? Right. Okay. So we have questions here. The global trade and investment opportunities in Asia. I think the question is for Ronald. The supply chain shift, how it will shape the global trade and investment opportunities in Asia.
Okay. The supply chain relocation did not happen yesterday. It actually happened quite a few years back when President Xi was talking about value upgrade, quality growth. I think he talked about that 4 or 5 years ago, and to mobilize or relocate the importance of export and then shift it to domestic consumption. And I guess on the back of that, you've seen companies want to move up the manufacturing value chain to identify opportunities where they can earn higher margin, and then relocate those lower margin business to elsewhere or to outsource to other parts of the Asian region, especially the ASEAN region. And so if that relocation is successful, then the end game should be that everyone will benefit. Because everyone move up that value curve. The ASEAN guy will move one level up, the Chinese will move one level up. Then you get a much bigger market. And obviously the trade tension accentuated that move, and that become more of a talking point over the last 18 months or so. And so I think the key to remember is that it's not just the US or the European clients who want to diversify. It's also the Korean, the Taiwanese, the Chinese themselves also want to diversify because of this value curve upgrade. So the beneficiaries of all this has been more apparent over the last 12 months or so. For example, Taiwan. The government from Taiwan has been very vocal about this, and I think in the early 2019 they actually give out a plan to the tune of like $3.5 billion worth of money to actually attract Taiwanese company to move back from China back to Taiwan. And I think so far about 200 companies actually assigned registered for that. And we've seen that some of the commercial property in Taiwan actually benefit. You saw the yield of that actually coming down. In Vietnam, there's also benefit. 2 weeks ago, I think Vietnam actually signed an FTA with Europe. And even before that, you saw a number of Korean company and certain Taiwanese company has been relocating to Vietnam. In particular, textile company, in particular, the tech-related type of companies. And how we get bottom-up opportunity is to look into some of those industrial estates, listed vehicle, whether they can benefit, and sure enough, they have. Obviously, the mass consumption consumer market will benefit from the Vietnam economy. And also given the fact that they're actually been recovering very well, the COVID-19 containment measure has been very successful in Vietnam, and that also helped to boost the local domestic consumption. So that together with the supply chain relocation means that the local consumer stocks would be a good vehicle for us to get exposure into this relocation of supply chain as well as the Vietnam stories.
Right. So it's not just China, the ASEAN markets also, if you look at some of these companies, you can also find investment opportunities. Thank you. Now, okay, this is a popular question. Okay, what's your view on China A shares?
Okay, actually, we like the A shares, full stop. But it's more than that. Actually, The Asia has done very well, but last year performance is mainly focused on the blue chips, man. This year, I think it's slowly moving to the middle and smaller cap companies. Especially, we find a lot of attractive ideas with our interaction with our Manulife TIDA analysts. We have a lot on the ground, so-called knowledge on these companies and the trends. So we are seeing very, very interesting mid-cap opportunities in the healthcare sector, in the consumer sectors, in the technology sectors. So we are positive. I forgot to talk about why I'm positive A-shares. You look at it, different from a lot of Asian markets, they are affected by the liquidity in and outflow of the markets. China has their own captive liquidity, and China is in an easing path like the US. So and they're also controlling the property prices. So a lot of liquidity is actually flowing into the Asian stock market. That's why I'm actually more positive on the Asian market than in a relative to what we in Hong Kong or even in Taiwan.
Thank you. So yeah, I think you've mentioned a couple of times on uncovering the names that are less covered by international companies elsewhere. So having the on-ground access is very important for to come up with these ideas. Now, okay, one other question. We're all hopeful that all the leaders of the world will be doing their jobs. So when do you think we'll get back to where we were? Will we ever get back to where we were, actually, in the next 1 year, 2 years? Any thoughts on whether we'll be getting back to where we were before the post-COVID-19, or the world has changed for stop?
You want to answer that?
Well, I think we talked about this right at the outset, that the way to do things will be somewhat different because on the back of COVID-19. But it's not because of the disease itself. I mean, we have SARS before, we know how to, and things will come around and it will go around and come around, right? There will be a vaccine. We don't know when. Interestingly, I was reading the news today that I think the Chinese is offering a vaccine for 1,000 people, volunteers, especially if they want to go overseas. And these 1,000 people, interestingly, are from the SOEs. So there are vaccines available. I think in total there are about 130 vaccines that is being tested globally, and China has 5 of that. So at some point there will be a vaccine. If not, there will be a population immunization. And it's something that we will get used to. But I think the pandemic has changed some of the ways that we do things. From a digital point of view, that we talk about how digital has influenced how we consume things, how we sell ourselves, how we market things, how we channel the products. And we probably will benefit on the back of that. Now we're doing a lot more VC now these days, and we're currently doing, which allows us to be more cost effective. And on the other hand, it also has its own problem. The stock market has been very strong. The stock market running on the belief that central bank will always provide a cushion. So it's more like a put option going into the stock market. And so at the same time, there will be consequences on the back of that after everything's recovered. So who's going to foot the bill? So I guess there will be social issues on the back of that. Where's the source of the virus has been much talked about. The have and the have not will be becoming increasingly divided. So there will be there will be a social cost attached to it, which is more down the road. And that's something which I think investors need to think about, and how to allocate the money. Just by putting into an index or into any market will only give you the beta. But I think because of the pandemic, it actually changed the behavior of how people consume, react, and transact. And because of that, that would give rise to different sets of opportunities. We talk about the digital healthcare, and so on and so forth. And that would lead us to?
Yes, it's interesting when you talk about index. I mean, to be a bit more blunt, the index player are likely to be losers. Those are big companies. They are emerging new guys are not in the index yet. So these are the digital economy, the emerging tech companies are not in the index yet, and they're actually benefiting from this post-COVID trend we are seeing. So that's why it's a good time for so-called bottom stock pickers like us, long fund, that we could look for winners in this big change in operating environment.
Right. So I think the short answer is that it's very unlikely that we will be going back to where we were before COVID-19. There will be some changes that are that are structural changes that we have to manage, and that investors should really think about where to look for opportunities, while at the same time have to be very careful about risk and not just go into blankets. I mean, go into opportunities. Treat all the opportunities equal. So I think that's the message that's from your discussion or from today's discussion that's quite apparent. So I think that brings us to the end of the panel and also the question session. Thank you very much, and we look forward to speaking with you soon.